All right. Hello, everyone. Tim Davis here. Yet again, giving you guys another weekend market review. Today is January 29th, 2022. And again, for those of you guys who follow any of my social media sites, you will see this personal market review that I'll be doing personally for anyone who wants to see. And you can get the link that I will be posting probably every week on my personal YouTube channel. And I will share that link on my Twitter and Facebook pages as well. Okay. And for those of you guys who know folks who used to follow me or want to follow me, send them here, and I will constantly provide you guys these weekend market updates on a weekly basis, as long as I can, to the best of my ability. So if I skip a weekend, don't worry. You can reach out to me personally on my Facebook or Twitter to find out when's the next one. For sure, invite anybody to come and follow me. This is something that I've always wanted to do, with or without a company by my side. It's something I always wanted to do, to be able to share, folks, my journey as I navigate through the stock market, as well as give you guys what I personally see as it relates to technical analysis. All right. Now, I'm going to start off with looking at this Wall Street Journal's market update, which I got from, and I'm going to show you guys, I'm going to share you guys a link with a gentleman I follow. I started following earlier last year, named AJ Monty, and he has been on point with a lot of his analysis. So I pick up a lot of stuff that I share with you guys from AJ Monty's weekly review that he does for Market Rebellion, and I will share his YouTube channel with you guys as well. So AJ Monty posted this on his Twitter page, and I since then posted on mine as well, because it also tracks market breadth. The tool that I normally use to track market breadth within the S&P, this is just as good, but it gives you direct insight as far as the amount of highs and lows that the market is showing on a day in and day out basis. So every week, every Friday, I make sure I take a look at this, but I look at it every day throughout the week. But every Friday, right before I do my market review, I want to show you guys this. So just to get us a general idea of what's happening beneath the surface. And even though, there was a strong rally in the market on Friday, with that said, a lot of people think, oh my goodness, this bull market is ready to run again. Pump the brakes real quick and let me show you guys this. So here is, and what you'll see in this first line here, it says new 52-week highs and lows. So they got two tabs here, one for the New York Stock Exchange, one for the Nasdaq. We're gonna look at both, but first let's take a look at the New York Stock Exchange. So this shows you, the very first section of paragraph shows you the new 52-week highs that were created on Friday, as of Friday. So it shows 11 new 52-week highs. Great, right? And let me scroll down and show you how many new 52-week lows we had with all that rally in the market we seen on Friday. New 52-week lows, 542. And you tell me that this market is still in a roaring bull market. I would beg to differ. I think what we're in is in the middle of a bear market rally. That's what I personally think. Okay. So again, that's the New York Stock Exchange. So you got to be careful when you're navigating through these markets and you see these big rallies and you decide to jump in. Be ready to, if you are swing trading or day trading or short-term trading, put stops in and be ready to take your profits, because this is going to be a fast moving market and it's going to probably last like this probably for quite some time, maybe the bulk of the year, and maybe even further. And I'm going to show you guys some reasons why I think it could be a lot longer than what we think. All right, now let's switch over to the Nasdaq. So what do you think about the Nasdaq? Wow, there you go. Friday, Nasdaq recorded 24 new 52-week highs. Okay, let's scroll down and see how many new 52-week lows are recorded. Voila, a whopping 1,168 new 52-week lows. So you think that bull rally we saw on this past Friday is something to hang your hat on and say, okay, I'm back in this bull market with 2 feet. You better pump the brakes and be careful. All right, got that out the way. Now, let's take a look at the tool that I like to use a lot. Let's get rid of you. Back here. All right, so here we go. So first of all, I always like to keep my eye on the VIX because the VIX tells the story. Now I'm going to stretch this out to a longer term VIX, and I'm going to shorten it because I would like to point out, I like to put things in perspective. Now here's our VIX on a daily chart dating back the past 2 years. And for those who've been following me, you know that what I pointed out probably a while ago is that the VIX, after the VIX made that big pop back during 2020, the COVID plunge, you can see this big rally in the VIX back then, and it was a quick, sharp one. So it was a big rally in the VIX. We rallied up to about $85 in the course of less than 2 months. And then we since then started to come back down. But look what we did over the past year and a half. We came back down, and the VIX found support, folks. And I'm going to show you guys a support level that proved to be a strong support level. And it held that level for a while. So with that said, that made me really start to pay attention to what future action could mean, because future action could mean that the VIX has found its bottom for a while. And you see that well down here where this right where this white line is at the bottom, right around the $16 level, VIX found a support level. So from April of 2021 all the way to January of this year, the VIX, every time the VIX bounced, it will pull right back down to around that level, that $16 level, until here recently, and the VIX started. So we were not able to create lower lows since then, and the VIX has been creating lower highs until recently. So now the VIX is no longer creating lower highs. As you can see, highlight these highs. So the VIX was creating lower highs, and I'm just highlighting some of these. Until here recently, now we're starting to create higher highs. So we're creating lower highs. Now we're starting to create higher highs, as well as the support level has been moved up. Okay, and I say that to say this, that I doubt very seriously that we're coming back to this $16 support level anytime soon. I think the VIX is starting a trend higher, folks, a longer term trend higher. So that's something to pay close attention to now that we are starting to create higher highs on the VIX. That is a bearish signal for our overall markets. All right, so I wanted to point that out, that I think the tides are turning, and I think officially, and as you'll see, AJ Monty says in his YouTube page, when I shared with you guys, for those of you guys who don't already show them, that I think this market is, I think we currently definitely starting a new bear market, not a new bull market. Okay. Now let's switch back to shorter term time frame. Now, in the near term, I think the VIX will pull back for you short term traders. So VIX got up to as high as 38.94 on this past week, and we since then traded back. Now, highlighted some areas where we can see the VIX possibly find some kind of support. So the range, is in right between this 23 to $26 level. The VIX will probably find support within that range sometime next week, and I would say probably before the end of next week, The VIX will probably find support between that $23 to $26 range. And then next, I think the VIX will start to march back up and eventually break out above that 38.94 level. So at the beginning of the week this week, we could continue to see this rally, this bear market rally, or this bull run within the bear market. We'll probably continue to see this for the next, couple of days or so, maybe Monday, Tuesday, possibly Wednesday. And then we have to see what the VIX does towards the end of the week. I think the VIX will eventually turn back around and head higher after it gives the bulls a nice little run at the beginning of the week. So that's a daily chart on our VIX. Now, I want to switch over to SPXA 200R, because you guys know this is also a tool I like to track to continue to pay attention to market breadth within the S&P. So I pointed out, let's see, is this going to show me this? It may show me what I'm looking for. Let's go back here, also about a year. Okay. So last year I pointed this out, that now this is the percentage of, this is a tool that tracks a percentage of S&P 500 companies that are trading above their 200-day moving average. And I pointed this out last year. I told you guys that the VIX, that this tool got as high as 97%. That is an extreme level, meaning that 97% of the S&P 500 companies were trading above their 200-day moving average back in April of last year. Now let me stretch this out before I break down this daily chart. Let's stretch it out to a monthly chart, and I'm going to show you guys history. So back in history, look at that 97% that we see now. Let's look to the left. If you notice, that 97% appears to be the highest we have seen probably in a very long time, or probably the highest we've seen ever. Because even looking at what happened between 2007 to 2009, we were only showing a reading of about 92% of those stocks trading above the 200-day moving average. And every time we get between that 90 to 97 level, look what happens. There's normally a pullback in the overall breadth of the market. We've seen it rally again after 2009, from 2009 up to 2010 or the middle of 2009. We rallied up back up to that $90 level, 90 percentile level, and we hung there probably for, almost a year, a slight pullback here and there, but then pulled back drastically again in 2010, and then we rallied back up there. So every time we got it, my point is, every time we get around this 90 to 97, 90 to 90, above 90, there's normally a drastic or a further pullback in the market. And what I'll point out is that the more extreme the market gets, the market breadth goes to the upside, the more extreme we'll probably see to the downside. So I say that to say that this 97 was the highest we've seen. Now let me look at some indicators while we're looking at this. This is a monthly chart. So look what the monthly charts are showing us. Now, today is January the 29th. There's one more trading day in this month, and we already have a big red candle in the market breadth for January. I doubt very seriously that in one day that the overall market or the overall stocks in the S&P 500 will rally hard enough to put the majority of them back above the 50 level, or 50% percentile. And even then, even if it does rally back above the 50% percentile, I doubt if we rally all the way back up here to where this red candle started down at, in the 75%. So with that said, I think we're going to finish January with a red candle on the breadth of this market and on the major indices, and I'll show you guys that in a second. So January is pretty much going to end up in a wash as a red month, which means we finished the month lower than the way we started. So January is going to be finished with a red month. I honestly think that February is going to start a new red month. And I think we'll finish February with a new red month. And I'm going to show you guys the reasons why I feel that way by looking at the technical analysis. So now that we have a big red month that's showing on this January candle, we already dipped below 50%. So we went from 97% back in April down to below 50%. And we may rally back up to 50% between now and Tuesday. That's a huge possible chance, but I think it'll get stopped because this is a strong area of support now. I mean resistance now. So on the way back up, I think we'll get muted right here, right around that 50 level, come Monday or Tuesday. Now, look at the TTM squeeze. As you can see, momentum is dying, which means the upper momentum is constantly losing its steam. So momentum is losing, the upper momentum is losing its steam, and we are switching to a downward momentum or downward range. Look at the four stochastics. Everything is negative. Wins percentage is negative. RSI is not even in oversold territory yet on this particular tool on a monthly chart. So, and it's still pointing downward. So I think and the trend is downward on RSI on a monthly chart. So I think there's a long way to go before we see a sustainable, viable, longer term reversal in this market. Here's a weekly chart. Now, while we have hit oversold territory on the RSI, we have not dipped below that 30 level. Look what happened last time. We actually dipped below that 30 level, backed on the COVID plunge. You know, we bounced around down here for a bit, and we even went a little bit lower. And right now, we are not even in oversold territory on a weekly chart or of the RSI on this particular tool. So that leads me to believe that we still could go even lower, even on a weekly chart. Now, our wins percentage shows a little bounce here, and I think that bounce will be sustainable the very first part of this week that we're coming into now. And the full stochastic still looks negative. So, and we still trading just below the 50% level. And I think we'll probably stay around or below that 50% level, even with a bounce on Monday and Tuesday. Now let's go back to a daily chart of this tool. Okay. So here's the reason why I think we're definitely going to see some type of continuation of this bounce in the market. Because on a daily tool, if you see every time we got around these oversold levels, there, here, and now big time oversold over here. So every time we get around those levels, we see some type of bounce. But let me draw your attention to every time we've seen those bounces since we've been trading below that 97% level. Every time we got those bounces, they were short-lived. As you can see here, and I'll highlight these. And I think this one's going to be even show even more move to the downside. So here's a bounce here. And then we went right back down and it started doing all this sideways action and not really jumping out to new highs. And then there was another down move here. And it even went further down than the previous levels that we've trended down to. Then another little bounce after we get oversold. Up just a little bit more, and then a big washout till we get till now, and we're deeply oversold now. So while we're deeply oversold on this particular tool, I think the percentages are going to rise. We went to as low as 35%, folks. That's well below 50%. So then the market, then all of, the machines jumped in. When you hit these extreme levels, when you hit these oversold levels, the machines take over and they push price action or they push these percentages higher. So I think we'll rally back up to this 50% percentile, get probably right around 49 to 50%, which is where there's some strong resistance. And I think from there, we'll head right back down. So that'll get us out of the oversold territory. Then from that, I think we head right back down with the market breadth. Now let's take a look at the major indices. Oops, didn't mean to do that. So now we'll glance at the individual indices and then a couple sectors before we wrap up this weekend's review. Hopefully this stuff is helpful for you guys who still continue to follow me personally. And again, this is something that I love to do. So it's something I'm going to always do regardless of where I am or who I'm sharing it with. All right. All right, now let's go to take a look at the S&P. Let's start with that one. All right. All right, now I'm gonna really point something out to you guys on S&P, and we're gonna because I already started to uh do some analysis on this, and this is what I found. Here is a longer term weekly chart of S&P, and I'm gonna see if I can even switch this to make it look more well defined. Switch it to a 2-year daily chart here. All right, so back here on the left side of my screen is the COVID plunge. As you can see, we pulled all the way down in there, and then we went jumped back up in a channel, in a new channel, and started to move up. So we continue within this channel all the way up until we reach 48.18 on the S&P. And guess what, folks? We fell out of that channel. Now we should start to experience a longer term move down and start a new channel downward. I think this is where our bear market starts. So this level here, price action right now on a daily chart, I think we could see a rally back up. Maybe not even back up to that I don't think we're not going back up in this channel, I don't believe. I think we because right now we're definitely seeing oversold territory on the S&P. I'm sorry, on the RSI. Move this. Get rid of some of these old drawings. So we definitely back into oversold territory on RSI. So I think we're just experiencing a bear market rally. So look at the RSI, the bottom of my screen. Well, deep into oversold territory, and then we're starting to get this bounce. Wins percentage starting to show a bounce. Full stochastic showing a bounce. TTM squeeze showing the negative momentum is losing its favor in near term, and we're starting to turn positive with the yellow bar. Now, I think this to be very, very short-lived and muted. Now we have some resistance. I'll mark it right here. So right around here, there's some resistance right around there. So here are my targets. We can rally back up to about 4,500. That's a possibility. With this, with so anywhere between 44.90 to 4,500 is where we could rally, and then we have to see what price action does from there. If we surpass that 4,500, we could see even rally even a little bit further. But I think somewhere around this area here, there's some resistance here. Somewhere around this 4,500 level, I think we're going to run into some resistance, and then I think we'll resume the downtrend. So we have to see how that pans out. Look at the longer term picture. Oh, that one. Oh, this is a good one to look at. It's a monthly chart. So I've been pointing out the monthly charts for you guys for long term, and I told you guys that this monthly chart has been on an extreme level to the upside for a long time, and I said eventually it's going to reverse. I'm telling you guys that all last year, eventually it's going to reverse. And look at that. Look what's happening on a monthly, folks. You can really see this channel has been pierced in a big way. Okay, with the TTM squeeze showing momentum to the downside, full stochastic showing momentum to the downside, wins percentage showing momentum to the downside. RSI is out of overbought territory. All right. So we got our first big trend break on a monthly chart here in January of 2022. And I think this will continue. I think we're going to start to see a lot more red months, folks. And this could be sustainable, folks, for a while. So again, this is a monthly chart we're looking at. Look at the breaking trend on the monthly chart. Look how steep that rally was from the COVID plunge. See how steep that rally was? Now I'm going to show you guys what it looks like with a couple moving averages in it. I'm telling you that this longer term, this downtrend is just getting started. And I think these are every rally is going to be sold. So don't get stuck holding the bag. So here is how it relates when we show the moving averages. And I point this out to specifically tell everybody that the 50-day moving average and the 200-day moving average act as magnets. Okay, look at the strong channel that we've been in since the COVID plunge. Rally right back, bouncing off of the 50-day here, and well off the 200-day. We're nowhere near the 200-day. And look back in history, all the way back 2007, 2008, 2009. There's not a time we've been so far away from our 50-day and 200-day than we are now. So first, we've been away from the 200-day and 50-day moving average over the past 30 years. I say that to say that this move down could be sustainable and long. So all these rallies that we're going to experience within this bear market, don't get stuck thinking that a new bull market has arisen. Until we start to see, and this is what I'm really looking for. I'm looking for some possible oversold conditions on the monthly and weekly chart. So when I start to see RSI dip down here close to this oversold on a monthly chart, then I'll start, paying very close attention, because I think that's what's going to happen. I think we're going to get oversold on the weekly and the monthly charts. So this is a weekly chart. Weekly chart has a ways to go before it's the 200-day on this S&P, and I think we're going to hit it eventually. We're just starting to break or test the 50-day now, and I think we're going to break through that eventually after we get through this rally that we're experiencing now, and I think we're going to head down towards that 200-day moving average on the weekly chart of the SPY, and then we have to see what happens then. All right, so broke down the SPY, showed you guys what it's looking like. Now that's the S&P. Now if we look at the SPY ETF, same scenario. This is a way that you can play this negative move on selling some of these rallies. So big rally on last week, causing this big green candle to pop up on the weekly chart. Now we're hovering just right around that 50-day moving average. I think eventually this next week we'll probably see a continuation of the rally, and then all of a sudden, probably by the end of the week, we'll probably see another reversal back to the downside. TTM squeeze on the weekly chart is negative on the SPY. Should I say the momentum to the upside is losing its steam on the weekly chart. So any rally in the beginning of the week will probably be sold by the end of next week and the beginning of the following week. That's what our SPY tool looks like on a weekly. SPY ETF, and there's a SPY ETF on a monthly. And as you can see, we are just starting to see some movement on the monthly chart to the downside. All right, let's go to the Dow Jones. All right, here's our Dow Jones monthly chart. And again, if I was to stretch this out, you'll see that it too is well off its 50-day moving average, and definitely well off its 200-day moving average. And also on this monthly chart, look at the wins percentage. How it's just starting to nosedive. Oscillator is starting to nosedive on this monthly chart. RSI is just starting to dip. So the RSI is still hovering around all the time. I mean, still hovering around the 70 level of the RSI. There's another reason to believe that this downturn is just beginning. RSI is still elevated around 60 now, so it still has a lot more room to the downside. It's definitely not oversold yet. So the weekly chart's not oversold, monthly chart's not oversold, and I think those will have to be oversold before I have any conviction that we could be looking for a possible good reversal, sustainable reversal in the market. All right, let's switch to a daily chart, and again, here's the oversold territory on the daily chart showing. So I still think there's going to be like a little rally in the overall market the first couple of days, maybe back up to these moving averages. But what's happening, folks? This is what I want to point out, is that these moving averages now are definitely going to start acting like strong levels of resistance. And what you'll notice, folks, is that as these moving averages start to cross each other, so this yellow one is my that's my 20-day moving average. As they start to cross, you'll start to see the move to the downside accelerate. You know what I'm saying? So we got the 20 days already crossed below the 50-day. It started to get us crossed right around here, and look what happened as it started to dip. You see price action just started to flush. Then as we dip below it, price action started to churn sideways a bit. Look where we are now. So this is what I really expect to happen, for price action to run close to these moving averages. But as price action is rising, I think the moving averages are going to continue to start to dip. And once we dip, price runs into the moving averages, then it'll start curling over. Once that happens, once we start to see on a daily chart, the 20-day and the 50 start to dip below the 200-day, watch out below, because then it really is going to accelerate to the downside. So right now on the Dow Jones, we still have the 50-day and the 20-day above the 200-day, but I think once they cross it, and I think they will, we're going to see an extreme acceleration to the downside. And I didn't point that out on the SPY, but I think the same thing's going to happen to all of these markets. Once these moving averages continue to cross, like here's SPY, the S&P 500. We got the cross of the 20 below the 50-day. Now price action is starting to rally. Don't think the 20 is crossing back above the 50. I think both will still continue to curl downward. As prices rally, it runs into the moving averages. Moving averages push price back lower, and then we continue to see the 20 and the 50-day start to bend downward. And once they bend downward and drop below the 50, we'll start to really see, drop below the 200-day, we'll really start to see an acceleration to the downside. So again, folks, until these moving averages start to, curl back up and get back in succession. And what you're noticing is that normally on the way up, you see these moving averages in line on the way up, in a bull market, which means you have the, and I'll show you guys what it looks like here. So a normal bull market, and you can't even see my 200-day. Normally you have 200-day on the bottom, 50-day next, and then your 20-day. And they're all in line, space in between, nice strong bull market. But when we start to see a change in market action, this is what you start seeing. You see the opposite. So eventually we'll have the 200-day on top, 50-day below that, 20-day below that, with price action following it downward. I think we're going to see that on the daily and eventually on the weekly and maybe even on the monthly. That means that's a sustainable long-term trend downward. All right. Now back to did the Dow Jones. Now let's look at the Nasdaq. For this, I'm just going to look at the NQ, which is the Nasdaq futures, because it's easier for me to pull that one up. And I like to look at the futures anyway to pay attention. All right, now the Nasdaq has been more oversold than the rest. However, look at this daily chart of Nasdaq. We already have the 20-day ready to touch. It's touching the 200-day already. So the Nasdaq can see a little rally, and then it's going to run into some resistance, folks. Probably real quick, probably a lot faster than others. Right around when it reaches this 20-day, maybe even up a little bit further, we'll continue to see these moving averages bend downward. The 20-day cross below this 200-day, we'll see the 50-day start to follow, and it's going to be lights out. It's going to be lights out for the Nasdaq. So that's just food for thought. As the Nasdaq will probably accelerate to the downside a lot sooner, a lot quicker than others, because we already got the moving averages that's already starting to touch 200-day moving average on a daily. Here's our weekly chart of the Nasdaq again. Probably see a little rally back up to this 50-day, and then I'm looking for these moving averages to really start to roll over and head downward. So by the end of next week, these rallies will probably be, muted. Rally a couple days in the beginning of the week, and then all of a sudden, the sellers are going to kick in once price action starts to run into these moving averages. The sellers are going to kick in, the machine's going to kick in, and it's going to start to push price back downward. That's my speculation. Now, here's a monthly chart of the Nasdaq, and look at that. If that ain't giving you a story, I don't know what is. Look at that big red candle from January. And again, folks, we only got 1 day left. That big red candle is engulfing, a couple of these candles already. That's a sign that this selling in January is just the beginning of a red month, beginning of one of the red months in 2022. So 1 red month already in January. I think February is probably going to be another one, folks. Before the month is out in February, I think it's going to be another red candle that's going to show a red month. I'm sure a down month. We're gonna have another down month in February. All right. Okay, so those are I think that we covered everything. We covered the Nasdaq, we covered the Dow, we covered the S&P. We took a look at the tool that tracks the percentage of S&P 500 companies trading above their 200-day moving average, and we looked at the Wall Street Journal market report that shows the breadth of the market. And you guys see, you know, what I see. You know, this rally that we're in now, I think it's just a bull market, a bull run within a bull rally within a bear market. All right, so don't get too excited, folks, about what we're about to see. If you're trading some of these stocks, just be careful and be nimble, and put some stops in, because you know, lot of stocks will report earnings coming up. Earnings are probably some of them might be good. Apple had a good earnings report, so Apple's in rally mode. Even with Apple, folks, be careful with this rally, because I just don't see Apple, you know, outpacing this market to continue its bull run. I think eventually, you know, Apple could even go higher. It could even make it back up to 80, because Apple is a good company, and it trades well in these conditions. But once the market starts to hit certain resistance levels, I think Apple is going to see the same, and it's going to start to roll over as well. So that's just food for thought. All right, folks. I hope this is something that was helpful for you guys. And like I promised you before, here is, if you want to follow AJ Monty, just go to YouTube, type in AJ Monty Weekly Report, and I guarantee you'll start to see where he shares his weekly report. So just go to YouTube, type in AJ Monty Weekly Report, and you'll get these. He normally does these every week, and you'll see some of the stuff that he's pointing out, some of the same stuff that I've been pointing out for a while. And I just found him not too long ago, and just giving confirmation to some of the things that I also see as well. But continue to you know, follow me on YouTube and on my Twitter and on Facebook, and also add AJ Monty Weekly Report to your weekly studies, and you won't go wrong by being directed as we travel, as we go through the end of a possible bull market and the beginning of a bear market. All right, folks, until next time, this is Tim Davis from Tim Davis. I didn't mean to say that, folks, so forgive me what I was about to say, but it's Tim Davis signing off, and I will catch you guys on my next weekly report.